Okay, I'm here with Ariane Shihai. He's the broker of Signature Real Estate and the owner of Investing Architect. How are you, Ariane?
I'm doing good. How are you?
Well, thank you. On this call today, we wanted to talk about what will happen to the Houston real estate market as a result of the coronavirus. It seems to be the most prevalent question we're getting from all of our clients and our investors, and wanted to get your take on what we have to look forward to in the future.
Do you want me to look inside my crystal ball and just kind of tell you what's going to happen?
Absolutely.
Okay.
Mine's in the shop, so
Okay. Yes.
I figured we'd
Same,
use
same
yours
with
to know.
yours. Do you take yours to Midas maybe? So, well, so that is a very commonly asked question right now, right? People want to know, what's going to happen, and it's hard to answer that question because it's such a multi-layered question. But really, when buyers or sellers or investors are asking that question, what they really want is, let me shut that off before 500 calls come in. Okay, so what they really want to know is kind of like what's going to happen to the market as it affects them, essentially. Right. So what they want to know is, like, if I'm a buyer and I'm thinking about buying a house, what I want to know is, are prices going to come down? So should I wait and then just buy later, or are things are going to stay the same? Sellers are going to say, well, is it a good time to put the house in the market now, right? Or should we wait until later? Investors want to know, kind of like, hey, if I already own property in Houston, what's going to happen to the values of the properties that I own? And then on the other side, well, what opportunities may be coming down? In other words, if prices are going to come down later, that could be an opportunity to acquire, right? But so it's really hard for anybody to predict exactly what's going to happen. But we can look at some fundamentals. In other words, let's say that most people are thinking prices are going to come down, right? Well, let's look at, like, what does it take for prices to come down, right? And what it takes is basically, it's a supply and demand question. You've got a supply of houses on one hand, and you've got demand for houses on the other hand, right? So when we look at supply, the thing to understand, and a lot of people are making comparisons to 2008, and this is a totally different beast to 2008 because what we're starting off with. So our start off point right now is that we've got low inventory. So the supply of houses on the market is really low. So in the March numbers that came out like a couple of weeks back, the inventory actually went down to like 3.5 months of inventory of properties on the market. That's a very low number, right? Now, a lot of people might say, well, but that hasn't reflected the coronavirus effects yet. And they're right about that. But the question is, well, what would it take for prices to come down? In order for prices to come down, the supply has to grow and the demand has to shrink, right? Because the way that the price of a property comes down is if you're a seller and you've got to sell and you put your house on the market and the demand's not there, but you have to sell, you have to bring the price down, right?
Exactly.
But the question is, if you don't have to sell, like right this second, you could probably hold off, right? And well, what if the demand is there, right? Houses are selling right now, despite people thinking that everybody's staying home. So in order for that to happen, the supply of houses on the market has to be a lot higher than it is now, right? So how does that happen? Like, where's that supply going to come from? Well, it can come from two places: either sellers that need to sell and they can't wait till later, right? Because for whatever, like, their life situation requires the house to be sold now, or it has to come from distress. Like, it has to come from people who are losing their homes. Like in 2008, you had a lot of people losing their homes. Banks take the homes back, they bring them on the market, and you get this flood of supply, and the demand's not there, right? But the distress is definitely not there now because banks are working with borrowers. Like, they're pushing their payments for 90 days. Nobody's, the government's coming in and injecting stimulus, sending money to people and businesses, right? So there's going to be distress later, but in order for that to work through the system, it's not something that, okay, well, this is lifted, prices go down 20%. Like, that's not how it works. And then on the other side of the equation, which is the demand side, you have interest rates that are lowest that they've ever been. right? So if you're a buyer and you need to move, this is a good time to buy, right?
Exactly.
It's a good time to buy, not because, I'm a cheerleader realtor. Always a good time to buy, always a good time to sell, right? But really and truly, like if the interest rates are at 3.25%, and let's say you're looking to buy a house for $200,000, right? If you compare a house at $200,000 at 3.25%, or you can get, let's say, that same house for 10% cheaper, but interest rates are 3.75, you're essentially buying the same house.
Same house.
Because
Right.
really, you're not buying the house, you're buying the financing terms, right? Because most people aren't paying cash for their properties. If you're paying cash, then paying less is always better than paying more. But if you're financing, the interest rate comes into play, right? As to, well, what does that cost me over a period of time? So the demand will definitely shrink from the coronavirus, because what we don't know right now, and this is the big question, is the next layer of this is the employment market. Like what's going to happen, because you hear these headlines about millions of jobs being, people filing for unemployment, but what we don't know is how many of those jobs are truly lost, and how many of those jobs are temporary losses, like furloughs.
Right.
Right? Because a furlough is where a company doesn't lay you off, but it keeps you, they stop paying you, but they at least keep you on their benefits list, right? And if they were truly meaning to fire their people, they would just fire them. They wouldn't keep them on their benefits list, which it costs them money, right? So,
Right.
So what we need to know is when this thing returns to normal, whatever the new normal is, how many of these people are going to go back to work, and how many people are unemployed, like truly unemployed. But more important than how many people are truly unemployed, and this is the difference between like just looking back at the experience with other crises that we've had, is that in 2008, you had a situation where if you lost your job, right, it would take you 2 years to get the next job. Now, I don't care how like fiscally frugal you are, nobody has 2 years of bills. Right. Nobody has 2 years.
Why don't you have savings? I don't understand.
Exactly. Nobody can prepare for that. Because the bill, the only thing that's not all the sports are canceled right now. The only thing that are not canceled are the bills. The bills keep coming, right? So that's the thing, is that it's more important than how many people lose their jobs, which is tragic. But more important than that is how long does it take people to get back to work, to some other employment. So if you compare 2008, the story that I gave, that people would take 15 months, 18 months, 2 years to get another job. So you have extreme levels of distress, because it's like now if you have a mortgage and you're laid off for 18 months, you have to sell, or you have to lose your house, unfortunately, right? Whereas in 2015, we had a situation where people lost their jobs, but 3 months later, they'd get another job. And even if that other job was at a pay cut, let's say, it kind of keeps the distress at bay. Like you can still make ends meet, maybe tighten the belt a little bit,
tighten your belt.
You make it work. And that's where I think Houston has a little bit of a unique challenge, because on one hand, you've got the coronavirus effects that are going to be nationwide. Those are not, we don't get special coronavirus effects for Houston. Like everybody gets those. But on the other hand, Houston has the energy sector crisis, right? That's oil prices have come down. I think today they were below $20 a barrel. So that means there's going to be a lot of layoffs in that sector. I think the Greater Houston Partnership, I think estimated about job losses of about 150,000 net job losses for the year, which normally we create. Normally we create 80, 90, 100,000 jobs a year. But then again, the question is, how often does it take those people to get other jobs? Because it's not necessary that all those jobs will need to be in the oil and gas sector. They could be in other sectors, because there's a lot of, if you're a project manager, for example, for a oil and gas company, you can be a project manager for a company that's not oil and gas.
Right.
Right. And that's really what we don't know, is sort of this combination. What will this combination of, the nationwide coronavirus effects plus the oil and gas crisis going to do?
Okay. So as far as the opportunities are concerned, where do you see that going? I know we have a lot of owners that have the rental properties in Houston, and I personally know a lot of them are concerned with vacancies, and not just are their tenants able to pay, but how long are things going to stay vacant throughout all of this, because people just simply aren't moving, they're not looking at the properties. Where do you see that going as far as in Houston specifically?
Yeah, so for existing investors who own existing investments, like they've already purchased them, there could be opportunities there. I mean, there's going to be some challenges in terms of keeping the places rented, and then getting, maybe the tenants will be impacted by job losses. But again, once things open up, and I think we're a lot closer now to opening up than we were, say, 2 or 3 weeks ago. I think, the investors that kind of followed our model, which is a model of a higher quality rental, they're going to do better than the investors who said, well, I don't understand why you're paying so much more when I can get, you're buying a house over there and I'm buying a house over here and I'm paying so much less. I don't understand, why you would pay a premium. Well, they're about to find out why, because, I think I read there was a nationwide owner of multifamily units, and they were looking at, that they own multifamily units across the country, and they were looking at their rent collections, segmented by class, like class A, class B, class C, depending on the quality. And the rent collection, between class A and class C, the difference was tremendous. Like class A was collecting at 95% of rents, class C was at 80% of rents. And that's the difference, right? Because if you've got 20% vacancy, 20% of your tenants not paying, that's a problem, right? So I think if you're going to be in a situation where there's going to be a hard situation like this, you'd rather have a higher quality rental than a lower quality one, right? When things are good, like that plasters over a lot of cracks in people's strategy, right? It's like, oh, it's all fine, everybody's paying, so what's the difference, right? Well, the difference is when things turn, like they're about to, and like they've started, then the quality always wins during those situations. So I think, our current investors, they may need to work with their tenants a little bit, be more communicative, especially the ones that we're managing for them. We're always staying in touch with them, trying to find out, what's happening to them, what's going on, if their employment has been impacted, so, we can find out all of those things for them. But at the same time, I think if the beauty of owning real estate long-term is that you get to choose when you sell, right? That's the main difference between, a lot of people say, oh, well, real estate's not liquid and stock market's liquid. Well, that's both a feature and a bug sometimes, right? Because if it's liquid, that means that when you freak out, right, and your hair's on fire, you go sell. Whereas with real estate, you cannot go and sell it as easily. And during these periods of time, that's very important to sort of counter your fear-induced impulses, which is to sell and get out and just stay in cash and fetal position kind of impulses, right? Another thing is when the government starts stimulating the economy to the tune of $2 trillion, right? One of the things that does is that it tends to devalue paper currency, meaning inflation, right? And it tends to increase the value of hard assets like real estate. So I think if you are a holder of investment real estate right now, over the next couple of years, you will start seeing benefits, in terms of your property values going up, because not necessarily because of supply and demand, but because of the inflationary sort of policies that the government is following to combat this, right? So when you look at, for example, the government in 2009, right, to combat the 2008 recession, they did the same thing. I think they call it quantitative easing. Very nice term for we're going to print a bunch of money, right? And they did that, and look at what happened to real estate between 2010 and 2020. Look at that decade and see what real estate did. And and a big part of that is because of this policy, right? Because as they tell you, oh no, inflation's been low, right? But anybody who shops for groceries knows that the inflation has not been low, right? That the same $200 at the grocery store doesn't buy nearly as much as they did 5 years ago, right?
Not at all.
So that's the thing. Like for existing investors who, as far as their existing portfolios, the main thing right now is to communicate with your tenants, to work with them wherever possible, and to sort of rely on the power of the quality of the tenant and the quality of the property that you have, that's going to get you through this situation, right? And then the opportunities from here on out are that whatever you currently own is likely to be worth a lot more money because of the inflationary sort of policies of the U.S. government. And there's going to be more opportunities to acquire down the line, not because necessarily prices are going to come down. We don't know if they're going to come down or at what clip. But what we definitely know is that sometimes perception is reality. So if the seller perceives themselves to be in a strong leverage position where they don't, where you give them an offer that's slightly below asking price and they laugh in your face, right? They're not going to negotiate with you as they are likely to negotiate now, where maybe some of their contracts are falling through, right? That they thought they had a buyer and they no longer have a buyer. And then this, solid investor comes in and, he makes an offer and guarantees that he can close, right? There's going to be opportunities there to where maybe somebody who cannot handle that pressure, or maybe somebody who, bought an asset and didn't really build a nice, strong foundation underneath that in terms of having emergency funds, of having extra funds to cover the expenses in the event of a vacancy, or all these contingencies that, people who like risk seem to think are unnecessary, right? All the people that didn't do that, now they might find, like Warren Buffett says, when the tide goes out, we're going to find out who's been swimming naked. And there's been a lot of people that have been swimming naked, right? As far as real estate is concerned. So there's going to be some opportunities to acquire more properties for investors coming up.
Sounds good. And is there anything that you can maybe tell an investor with current properties that have current investment properties now, just how to, aside from the communication, because that's key. I really do believe that. A little bit of compassion also goes a long way, but anything that they can be proactive about, like, for instance, typically we do our lease extensions 60 days out or 30 days out, maybe reaching out to people that are expiring in July and seeing, like, while you're seeing how they're hanging in there, also maybe securing that extension just a little bit earlier, just to kind of, okay, this one's off my plate now, I can move on to the next one.
Right. And it's more about, right now, it's more about stability, and it's about making it through. Those are the two key priorities, right? Is like ensuring as much stability as you can for your portfolio, and can we make it through this? Right now, all of your measures of, all of your metrics, like, what's your return on investment, and how much is your vacancy, and what is, like, all those things, they matter, but they matter a lot less right now. Like, what matters right now primarily is, can we make it through this situation, and can we stabilize where we can, right? So now is not the time to go to your tenants and say, I'm raising your rent $100. Like, that's out the window, right? So if you can go to if you can go to a tenant that maybe has a job that is, either less affected by all of this, or maybe it's affected positively, like a nurse, or, like more essential type services, and they want to extend, this may be the chance where you can go in and say, hey, we really appreciate your prompt payment. You're taking care of your property really well. We'd be willing to extend it for you for a year at the same rent. There's not going to be an increase this year. And you can be proactive, and that can come in as almost like a favor, or a sort of a recognition of their, payment history, rather than trying to raise the rent. And then when they say no, you say, okay, right? That doesn't leave the same taste. And, the other part to think about is that right now you have to really evaluate your tenant screening, and sort of, just like you want to diversify, like you don't want to have all your properties in the same neighborhood or in the same exact location. You also don't want to have all of your tenants, let's say, in oil and gas, right? Because if something like this happens, then you are, extraordinarily affected by this. Yeah. So you want to make sure that, when you look at, so a lot of times when you have, people forget to stress test their portfolios and their situations when they're looking at a tenant. They say, well, we've got this person, and, he makes a really good income, and that's it, that's fine. But now, like, if you got two tenants and maybe they have two incomes, that's probably a little bit better than having one strong tenant with a good income that just went away. Right? So thinking about diversifying the, across the pool of tenants that you have, so that you're not disproportionately affected in terms of what's going on right now.
That's really, really smart. That's definitely something that some of our landlords might remember when all this started. It's like, what do my tenants do for a living again? Well, they're fine. They're fine. You had a nurse and a jailer. You're fine.
Yeah, so where are we with rent collection this month, by the way, or for April?
We only have one tenant that has not paid as agreed. We did have a couple of landlords that put their people on payment plans, just to kind of ease things a little bit. Like, they hadn't been furloughed yet, but they were getting furloughed in the future, and just to kind of make sure that they had money to live off of. But really just one tenant that hasn't paid as agreed yet, as of yet, which I think is fantastic considering we have 22 properties and
was that tenant like COVID-19 affected, or is it just a sort of a
the latter?
Okay.
I don't think it's a COVID-19. Their job is an essential service. I think it's just, even though sometimes we do screening as well as we can, sometimes life just gets in the way for some people and things change for them.
Gotcha. Okay. Well, no, that's really good, because that's a lot of times, investors are asking, like, hey, what percentage of your rents are you collecting, right? Because they want to see how their situation compares. And, unfortunately, if, your, a lot of times investors think that they're buying an investment property, but they're really buying like a tenant relationship. That's really, I did a video on this last week, where it's like, the tenant is the product. Like, the tenant is your customer. It's not, the house is the thing that they want, but really what fuels this business is your relationship with the tenant, right? And a lot of times, it's too late now to kind of go back and say, oh, I wish I would have gotten better properties, or I wish I would have gotten better tenants. Like, it is what it is now for, but I think it can be a very valuable lesson as people kind of come out of this and get on the other side of this, to reevaluate and say, hey, is there an 80-20 component here? Like, are there 20% of my properties that caused 80% of my headaches or more, right? And does it make more sense to, because now you got the benefit of hindsight. Now you can look back and say, how did that do? Right? You don't have to look at your crystal ball anymore. You can just look at the events that just happened. So, after this, you know, the sense is almost like there's almost this pent up demand to go back to normal. Like everybody wants things. Like if somebody came out tomorrow and said like everything's open again, I don't think restaurants could keep up. I think we need to flatten the curve for restaurants. So you know, I mean, because people are just like, you know, I never knew, right, that going out for fajitas was like really like the zest in my life, right? And but yeah, so there's this tendency that, you know, once you get on the other side of this, you're like, all right, well, I'm safe again. Things are normal. It's like, well, no, use this as a lesson so that, you know, you can, you know, now that you can see what can happen when, I mean, nobody could have predicted this, right? Like, no, that's why they call them black swans. Like if you think, like even after this, if you think, you know, the next one's always worse than the one before. So the one before doesn't really tell you much about the next one. So what you have to do is you have to say, okay, well, for something of that intensity, what are the lessons? What are the measures that I can take? For example, you know, always have more cash on hand than you think. I know, like, I'll get a lot of investors calling me and saying things like, I mean, it just irks me. You know, I've got money in this savings account and it's not earning anything, and I just want to put it to work. Well, if you put it to work and it's now sort of trapped in an asset, and now you need liquid cash to get through this period, you know, that's not good. So the cash reserves are almost like insurance. Like it's useless until you need it, and then you need it, and then it's like, okay, I can see why, you know, we did this useless thing all these years. So so that's
and that's why you build that into your blueprints too, right? Like that's why we don't say, let's just use all your money right now. It's a part of like, you need to have this much reserves, and that's why
because the thing is, you know, a lot of times, you know, I have this conversation. I mean, you know, talking about risk is never as much fun as talking about you're going to be financially independent and, you know, and have see you later money or whatever, right? But risk is really important to talk about, and people don't like to talk about it, and they like to say like, well, what's the risk? You know, if the tenants are paying my mortgage and they're paying their rent, the thing is like that, if like that's not guaranteed, as we just found out, right? That you know, well, what if they don't pay? How does your portfolio fare, right? What if you've got higher than normal vacancy? Then what happens? But that's the type of stress testing that we do on the blueprint. And it's like a lot of times it seems like overkill for clients, because they're like, well, let's just get to the good stuff. Show me how much I'm making in 15 years or whatever.
Show me the money.
Show me the money. Yeah. But the risk part of it is one of those things where it's like, you've got to do it before you need it, right? You've got to run through those scenarios before you need them, and then you can plan for, because otherwise you're just building a house of cards, and then it can fold. So that's why I'm saying unfortunately, there's going to be distress in, say, like multifamily real estate for people who didn't have the contingency in place, who were sort of, I mean, if you think about it, right? If you run your rental real estate portfolio without reserves, it's like you're living paycheck to paycheck within your multifamily portfolio, if you will, right? In other words, the moment that rent doesn't come in, you're screwed, right? So there's a lot of people that were running it that way because, you know, no way in hell people were going to stop paying. Why would they stop paying? It's such a great market, you know, like I can always find another tenant, you know, they're never going to shut down the whole place, right? Like all these things that, you know, that turned out to be true now. So, you know, you have to, like, this needs to be a lesson, and there needs to be sort of measures that every investor should take coming out of this so that they can stabilize. Just like after 2008, you know, they figured out, hey, you know, the banks weren't as capitalized as they should have been. And they were in a situation where you had, you know, too big to fail, kind of like, hey, if I fail, the whole thing's comes crashing down. And then they made, you know, they increased the requirements for the banks. Like, well, no, now you got to keep more capital. Now you got to do all these things. And now that's why the banks are now in a much better shape than they were in 2008, right? Which in 2008, the banks were more broke than the people, which is not a good thing to have, right? So that's why, you know, if you let this opportunity pass, the opportunity to learn a lesson from hindsight, and learn a lesson from the experience of having made it through something that is as dire and grave as what's going on right now. And if you don't do anything about it, then you can't complain when the next one happens that you weren't ready. You know, now it can catch you off guard because you didn't know. I mean, we've been, you know, there's a human bias of like we expect things to be like they've kind of been recently. So we think like, okay, well, if things are good now, then they're probably good for the next 6 months. And the thing is, things have been good for 10 years, for 11 years, right?
Mm-hmm.
So it's like, there's people who have been investing only on that side of the cycle. So they're like, okay, well, you know, I'm a genius, right? Every move I make seems to work, right? But the problem is that, you know, now that we know that, you know, how things can happen and how fast things can change, then, you know, that is essentially experience. You know, that's what, you know, those of us that went through 2008 and saw what happened there had to teach to the people that maybe started investing in 14, 15. And they're like, well, no, it's all going to go like this, right? The whole time, you know, up and to the right. And that's why it's like, now it's like, okay, that's the risk portion of this. So how do you then prepare so that you're next time more prepared for this and more sort of stable?
Well, good. So are there any other things that you wanted to touch on? Anything we didn't catch?
No, I think that's kind of what I wanted to convey. And
Yeah, I think it's perfect. I think that this answers every single question that we get on pretty much a daily basis.
I also want to
Sure.
I also want to kind of work with this longer form format. And so if anybody that's watching this, they have other questions or anything else that they want us to touch on, like I plan on doing these weekly. And so, you know, anything that's real estate related, investment related, economy, therapy, whatever, you know, just, you know, they can reach out to us and we can address them on these calls.
Okay, perfect. Well, thank you very much. Thank you for your time.
Well, thank you.
And we will be talking to you soon.
Okay, bye-bye.
All right, bye.